In today's episode, it's about those who want to have their property 100% financed by the bank. But is that really a good idea? We find out. Let's get started. Property purchases without equity, so-called 100% financing, are trending. Fall in loan interest rates after initially sharply increased rates, and at the same time, sharply increased rents make these financing forms currently attractive for many buyers, especially for investors who want to rent out properties. However, the risks should not be underestimated. Anyone who wants to find out what to consider and why a certain amount of equity remains crucial should definitely stay tuned now. Welcome to the new episode of From Saver to Investor. My name is Fabian Schuster and my vision is to narrow the gap between rich and poor in the German-speaking region. How can we achieve this? Well, when I'm not sitting here in front of the microphone, then I am exactly for this reason. I have been working for over 10 years as a managing director and consultant in our company, Capri Consult. Together, we have independently supported over 600 people in transitioning from savers to investors. And in collaboration with our clients, we have not only been able to build high 7 or even 8-figure assets, but also to preserve them. We want to share this experience-based knowledge with you completely free of charge through our podcast and YouTube channel, and all without any equity. And with that, we come to today's topic. The concept of 100% financing sounds very enticing. Not using your own funds, but financing the entire purchase price through the bank. Some banks even offer 110% financing, where additional purchase costs like property transfer tax, broker fees, and notary costs are also financed. Especially childless couples with above-average incomes benefit from these offers. In recent years, the demand for 100% financing has noticeably increased. Since the beginning of 2024, these account for about 11% of all real estate financing deals. This is an increase compared to 2023, when the share was just under 9%. Particularly capital investors who buy properties for rental purposes tend to opt for this more frequently. For them, about 1 in 3 financings is 100% financing, and that's exactly what we're focusing on now. Because when you take a closer look at the advantages and disadvantages, it's quite surprising that 100% financings are still and so popular among capital investors. But first, let's look at the positive aspects, or rather, the reasons why 100% financings are currently experiencing a boom. The trend towards fully financed properties can be explained by several factors. Firstly, loan interest rates have recently decreased, making financing costs more attractive. Buyers can calculate with comparatively moderate monthly installments despite higher leverage. Secondly, the significantly increased rental prices play a role. In some regions, these have risen by 25% over the last 2 years. As a result, purchasing a property often appears more profitable than renting an apartment, even without equity. Additionally, the purchase prices for existing properties have decreased, making ownership even more attractive. This development has further fueled interest in real estate investments and has led to buyers more frequently considering riskier financing methods. But not everything that glitters is gold. Gold, what glitters? For investors who want to build a portfolio of real estate and are not interested in a property for personal use, 100% financing remains a problematic issue that should be closely examined. With an increasing number of properties, the burden of additional purchase costs grows, which often have to be covered by personal funds, which is also okay. These can really add up depending on the type and number of properties. If these funds are lacking, the overall strategy can falter. Banks reject the subsequent financing because there are not enough securities. The financial consequences can be severe. Higher interest rates, limited flexibility, and potential over-indebtedness are risks that can jeopardize long-term goals. Therefore, at least part of the financing should come from equity to protect one's creditworthiness and ability to act. From a financial perspective, it is advisable to cover at least the additional purchase costs with personal funds. A classic 100% financing, meaning 100% of the purchase price. Plus, this no longer includes the additional purchase costs within the 100%, and as they are excluded, does offer an attractive entry opportunity. But it is not 100% optimal for investors with long-term goals. The strategy should rather be focused on stability and flexibility to not jeopardize future investments. For short-term goals, such as purchasing a single property without the intention of building a long-term portfolio, a 100% financing might be sensible in individual cases. However, a smart repayment strategy should be applied to cushion potential bottlenecks. Where can you get such a smart repayment strategy? Definitely not from the real estate agent, because in the end they just want to sell you the property, which is fine, but you should consult an advisor to handle it smartly. For example, you can also contact us through the contact form to get advice on a smart repayment strategy. The decision for or against 100% financing strongly depends on individual goals. And those who want to build wealth in the long term should use equity and pursue a sustainable strategy. If you feel addressed by this, don't hesitate to send us a message through our contact form. I also try to read every message personally. If you're interested in more content on real estate investment, feel free to tune in. Episode 260 of our podcast. We can indeed recommend Dresden as an optimal location for your real estate investment. Why? You'll find out exactly in this podcast. Have fun and see you next time, and don't forget to subscribe to our channel because there's an exciting new episode every week.